And on today's show, how the life settlement market can impact your practice. Part 2 of this week's series on life settlements with life settlement experts Erez Ratem and Alex Sorokin of Integrity Life Solutions, LLC. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmark. Let's get down to business. Well, welcome to the show again. Day 2, Alex.
Thank you,
Erez.
Steve.
Appreciate it. Well, we're living in the greatest mortality revolution that mankind has ever seen, and people are living longer. And when I think of life settlements, you know, people are living longer. How can life settlements be good then if everybody's living so much longer? You guys are using 3 to 4 different companies that measure life expectancy. Have they had a decent history of picking these timelines? Because that's what everybody always asks me. Steve, how's the timeline on this? Are they doing a good job?
Honestly, Steve, I think the jury is still out on that. But life expectancies have risen across the board lately within the last several years. And prior to that, I think in 2008, once before. So they are making systematic, adjustments from time to time. I think also, really, every fund is different. I think some funds are probably experiencing good profitability. Other funds are not doing so well. Our feeling is that from a fund's perspective, it's really a pick and choose. I mean, really cherry picking certain investments, certain policies, and really can't look at it from an across the board situation.
Erez, when we look at this from a strictly underwriting point of view, there's some little niche markets, that I think are not really quantified when we're talking to what I call traditional life expectancy reports when I'm reading them. Do you see any of these embedded values like I do? I see I tend to be more interested in fourth quarter issue contracts. Contracts that seem to be more benevolent underwriting because somebody had a shaving program, a table shaver. Talk a little bit about that because you've been in this side of this fence.
Right. Well, table shaving is great for our business. If you have somebody who's a table 3 and got a preferred, that's great. Obviously, that creates value. So those are policies that we'd be thrilled to look at and to buy. It's not always the case. Over the years, the table shaving programs have been reduced. So you're looking back a few years to find those policies.
Now, well, I want to go back on what you just said then. So I want to drop back how far, because I'm looking at contracts. Of course, we said in yesterday's show, you have to be online in force for 2 years. The contract has to be in force. But if we're looking for contracts that may have embedded value that maybe don't show up on a regular life expectancy report, I'm looking at how far back would you say? Is it 5 years back, do you think?
I'd say the table shaving programs probably stopped 4 to 5 years ago. I think you're right about that.
As far as really getting really quantifiable numbers. Yes. Well, let me go down one step further. I've also noticed that there were business decisions within companies' retention. He didn't have to do his automatic treaties. He didn't have to go out to facultative. He could make a business decision maybe because the producer was big or the independent marketing organization was such a big producer, it was such a big company that they could really call for a deal.
Right. Absolutely. Ash is definitely one of those companies. So if you're going to find value in policies, Ash is a company you're going to find a lot of value in their clients' policies.
Well, when I'm thinking about trying to measure and trying to come to an area of when our advisors are watching, they're probably saying, wow, I really want to get back into this market if this market is that. And now you're telling us that the inventory is low. We're now talking about and trying to quantify what to look for, like 5 years back, and older clients and clients that were written maybe and issued in the fourth quarter.
Right.
There seems to be a benevolency among underwriters during that period in time, probably because they're not making their marketing numbers, But when we're talking about looking at value, and as a funder, because I can see the advisor saying, hey, listen, this is really good for me, it's good for my client, but we have to look at it from a funder point of view. Am I going to get internal rate of return on this? When I'm looking at this, I'm looking at cash value policies. Would you say rule of thumb is that the funder is going to pay almost always the cash value or exceeding, or not necessarily?
Well, I think by definition, if what you're driving at is, are we paying cash value? We're paying in excess of cash value. If we didn't pay cash value, then if someone was interested in disposing of getting rid of their policy, they're going to go the easier route. Sure. Go back to the carrier and surrender it and get the cash value. So, every case is different. But you're looking at certainly multiples, perhaps, of cash value. If that's the answer to your
give me
question.
a window in there when you're talking about this, Alex. So at the low end, is it 2 to 1, 3 to 1, somewhere in that vicinity?
We hate as funders and as professionals to give, and and you're trying to pin me here, but it can't, because every case is different. And when you're talking about, certain types of policies that people should be looking at, that your advisors should be looking at, yes, we agree that those may be sweet targets to be looking at. But it doesn't mean that they should focus entirely their efforts on those. They have a whole portfolio to be looking at, and they should just keep an open mind and let the experts tell them what, if any, there's value there.
We come back from the break. Alex is going to hit the Mondo pad. We're going to show you how this works and some of the mechanics. We'll be back in about 30 seconds. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, Alex is going to walk us through the mechanics on the Mondo board. Walk me through all your little acronyms here. I really like it. We're going to walk through the buy-sell process.
Okay, this is really a very simple diagram of how sort of the distribution setup in life settlements works. And you notice that I've got a very simple board. You've got the sell side of the equation, and you've got the buy side. So let's start off with the sell side. Joe is our client. And Joe is dissatisfied with owning a policy and goes to his agent or his advisor, who is A, and says, what am I going to do here? He says, Steve, what am I going to do here with this policy? And of course, the advisor has any number of options. And I always underscore the idea that, we're just educating here, and life settlements is an option. It is not, it's not an imperative. But let's consider the options. It costs nothing for Joe to consider and for his advisor to consider life settlements as one of the options that he needs to put together for his financial plan. So Joe, the client, is dissatisfied. I don't want to keep this policy. I can't afford the premiums. He goes to his agent and asks these questions, and the agent has some options. He says, well, let's consider the life settlement option. But the agent, doing the right thing by his client, really is not an expert in life settlements, and he has a fiduciary responsibility to his client to do the right thing. So what should he do? He should really go to someone in the industry who is an expert, who has a fiduciary responsibility to him and his client. So he goes to B, and B is the broker in the life settlements business. B, the broker, has a fiduciary responsibility for A and for the client. Now, what does B do? B gets information through A. A is the advisor. It gets information on Joe's health and on the policy information, and of course has a HIPAA sign, gets medical information for the past 5 years from Joe, and with that information typically goes to medical actuaries within, you mentioned them in a previous segment, goes to AVS or goes to Fasano, other actuaries in the business, gets a LE report in months, and the report will say, Joe has a life expectancy of, let's say, 72 months, whatever it is. B wraps all of this up, all of this information, the medical information, the LE information, the policy information, and basically in our industry we have what I would call sort of an MLS system like you have in real estate, a secure portal that will go to the other side of the equation, to the buy side. Who's on the buy side? We have P for provider. What is the provider? The provider really is a representative in a legal way to F, the funder. These are the people with the money. These are the people who are making the ultimate decisions as to what they're going to acquire, what assets they're going to acquire, what pricing they are going to accept or offer. And these people have discussions with one another. P is the legal entity licensed. And by the way, I failed to mention, B and P are both licensed entities under state law. This area is regulated probably 43, 45 states. They any state that is where there is a statute governing viatical or life settlements requires licensing from the provider and the broker. Provider has a fiduciary responsibility to the funder. Broker has a fiduciary responsibility over here. That's basically it, unless you have any questions.
I do. Now, I just want to make sure the mechanics here. So Joe goes to his advisor, says, and maybe the strategy changed, maybe his planning, or like you said, he doesn't want to pay for this any longer. So he goes to his advisor and says, what should I do with this contract or contracts? He then goes to a broker. Now, could that be a IMO, or is that a life settlement broker you're talking about?
That's a specialized life settlement broker, and in most states there is a special license given. Now, brokers can, have producer authority. They don't have to go through. It depends. Every state is different, which sort of complicates our lives. We have 50 states, 45.
Nothing's universal.
No, nothing's universal. Everything. The little nuances between each state. So, but he is a specialist in this area. He might be doing other things, but he is a specialist, not just some IMO.
So, and then these two, not only the broker and the provider, they both have to be licensed. Now, the funder has received the report. Who on his team is making the call whether we're purchasing this policy or not?
On the funder's team,
right.
I think every funder is probably different.
So when they look at this and they review the policy, they're going to make an offer.
That's correct.
And that offer then will go back to the client through his advisor. And then when that offer is made, the client's going to make a call. Hey, I like this. This is a good deal for me.
Right.
And then they'll execute. From the time we start our first step one, where the client is actually saying, hey, I want to look at this again, to the time we have an offer, what is that time zone? Is that 1 month, 3 months?
That's a very sort of a leading question there, Steve, because it varies. But one of the, honestly, one of the problems we've been having in our industry is that often it takes too long. And from our experience, and of course, we try to make it very short, and we would like to say that we can do this personally in 45 days. But in the industry, generally, it's been taking too long, several months, 3, even 4 months, sometimes longer. And we have brokers who are unhappy with this area because there's lots of due diligence that gets done here. I mean, I'm talking about to contract. I mean, not to offer, but finally to contract. There's, and these people here are very concerned. They have a legal team. They're very concerned. So, but honestly, my suggestion to advisors is, if you're going to do this, take a look at it, get it done, but warn your client that timing is not certain. You want to set your expectations correctly with your client so that they're not hounding you during the process, because a lot of them are disappointed with the timing of this. Good question.
Well, that's all the time we have for our show today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, and your broker-dealer compliance department. Missed an episode? You can view all our episodes out at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.